Hello, everybody, and welcome to the weekly review. So I'm looking back at week ending the 6th of Feb, and I'm on the ES or the S&P 500. Now, this is a weekly chart. We'll do two things. So review the week and then review Friday specifically. I'm on MT4 this time, not TradingView. I just thought I'll do something different today. And I'm using a specific tool called VSA, Volume Spread Analysis Tool. Ignore the tool. I just wanted to show something specific. This is the weekly. So as you can see, let me grab a pen. There we go. All right. So you can clearly see we are in a very sort of narrow weekly range. The trend is up, which is good. So let's look at the overall trend alignment. All right, you can see that we are breaking up a little bit. Not, it's not really clear. I mean, the weekly is bullish and the monthly is bullish. So those two are aligned. I don't have the monthly shown on here, but the rest are, well, all over the place, right? So I'm normally looking for the 30 minutes, for example, and the 1 hour to align. So basically going in the same direction. And also the 4 hour and the daily to go the same direction. As you can see, none of them are doing that in any consistent way at all. But if we ignore that and just look at price, you can see we are really in a range. We are making very small higher highs, and then we're also making very small higher lows. Okay, this overall to me is a trap. Now we have this in the background. I've mentioned this in previous videos. It's called end of a rising market. And this, if I just grab this and show you, it's called end of a rising market. This principle is responsible for this sideways move. One of two things will happen. We're either going to expand rapidly upward or we're going to expand rapidly downward. But we are still in the gravitational force of this principle. Okay, this is not a good principle. It is leaning bearish. Okay, that doesn't mean it's bearish. That doesn't mean it will go bearish. It's leaning bearish. Think of it like a background information. All right, so that's the weekly. We're not really honestly doing much on the weekly. We're just taking out the highs and taking out the lows, and we're doing it slightly ever so little. Okay, I don't like that personally. Right. Now let's go to the uh, 5 minutes. So this is our operational time frame. This is where we like to be. And let me move a little bit to find Friday. Okay, so Friday. All right, so if you're not aware or have seen any of the previous videos, let me make this darker. I use a simple framework called the two-step model. It used to be called the FIB model, but I just changed the name just because it's easier to say. It's the same thing. So if you've seen all the videos and you heard me say FIB model, it's the same thing. It's an operational model. That is, I can use it every day. And it has 3 steps, just 3 steps. So by the way, this ignores your experience. Okay, this is just the model steps. The first step is for us to always find direction. Without direction, you can't do anything. You can't go to step 2. You can go to step 3. All right. Once you have direction, you move on to the next step, which is find the fair value gaps. I use the 5 minutes. Yes, it works on other time frames, but my experience, I just apply the 5 minutes all the time. And when you then find that and verify that, you move on to the last step, which is you make sure that that fair value gap overlaps with a fib. Now, a couple of things. First is you would want only one fair value gap to show up in that directional move. That really simplifies things. And normally there's usually just one. Sometimes there's more than one. And this is where your experience will come in because you have to either sit and wait, or it's basically sit and wait for the retracements to conclude, and make a decision as to which fair value gap is likely to hold, right? But usually there's one, and we just focus on that one. So this is 5 minutes. This is the Friday open. So I'm just ignoring everything in the background just because it's a bit flat. So we can use this as the swing low. So this is what I call anchoring. You anchor your price, your directional move from a time, so 9:30. Now, if if we didn't have this sideways move, I would consider the sort of extended anchoring. But for now, we use the 9:30. We then wait for that 30 minutes. That's my standard time. So I look at a price in 30-minute time boxes, or half of that, 50 minutes, if price is moving really, really quickly. So 30 minutes, 45 minutes, an hour, 30 minutes, an hour, 50 minutes, 2 hours, etc. Right? Typically in a micro session, so in the AM session, we're just looking at 30 minutes to 40 minutes. Okay, really small session. We're not trying to run the entire session. We're just really focused on the AM sessions, and that's all I'm looking at. So we get a clear, you can see clear swing low here and a swing high here, very clearly. This is 30 minutes. This is within the time frame. We have, I'm going to, actually, let me just use these. So you can see we have, let's change that. We have a fair value gap. Hopefully you can see that. Okay, there. And we have another one. We have it right there. Okay. All right. So, okay, 5 minutes fair value gap, right? So step one, we have direction. It's inside the 30-minute time box, right? 30 minutes or 45 or 1 hour. We move to step two. We have a 5 minute fair value gap. And luckily we only have one. So we don't have to overthink this. We then wait in step two for price to retrace back into the fair value gap, right? Step three is we look for the overlap, okay? So we're looking for an overlap between the fair value gap and your fib. That's the 50, okay? That probably also hits the 60 as well. So we have all steps that we need. So we've got step one, direction, step two, fair value gap, and step three, overlap. Now, after this point, it's experience. So beyond those three steps, the modeler said, hey, the conditions for my satisfaction are right here. That's the way I wrote the model. You have conditions for satisfaction. Again, this is based on where I work industry. So you have the conditions to be satisfied. Now it comes down to execution. So this is where the model leaves you and says, hey, now this is your experience. This is based on data. This is based on you looking at price over and over and over again. So what am I looking for? I've mentioned that when price gets into the fair value gap, there are a number of things I'm looking for, and they vary. Um, well, just bear in mind this is still the 5 minutes. I haven't even dropped down to the 1 minute. Sometimes I will drop down to the 1 minute and see what the 1 minute is doing. Especially on big fair value gaps like this. Sometimes I'll just leave it on the 5 minutes. What am I looking for? Well, all I'm looking for is a rejection away from that fair value gap, which we have here, right? I didn't drop down. You can see we've tapped it, rejected away from it. That's all I'm looking for. Any move back into midway of that rejection, you can take a trade from there, put your stop loss below that rejection or anywhere else. Now, this is quite large, so I wouldn't put it there. Okay, that's probably the safest place. Now, I am looking at this trend as well, so you don't have the benefit of that. So, well, some of you may have the VSA installed. Um, they do actually have it on TradingView, but it's not very good. So I can use this trend as a dynamic support and put my stop loss below it because price will use it as something to bounce. It's like an EMA. It's the same thing. But let's go to the 1 minute and let's see what we also see on there. So I talk a lot about things like you can see breakers forming, you can see head and shoulder patterns forming, you can see uh, all kinds of things, right? So find the thing that you're comfortable with. For me, a lot of the time, I'm just looking for a rejection. Okay, a rejection right there. That's what it looks like. Price goes in, boop, I don't want to be there, boom, rejects. Okay, now normally as soon as it rejects, you'll see price push away, forms a fair value gap, and then that's a strong rejection. Now I just wait for that push away, and then I'll just take the trade. But like I said, it doesn't happen all the time. So in this case, you don't get that push away, right? Price just kind of meanders a bit. You finally get that push away here for value gap, but it's far away from this, right? So this is why I say experience, where it comes down to experience. All I'm looking for, the best way to explain this is once I see that rejection, any move back into this candle is a buy. Stop loss below there. Okay, that's it. It's just a buy, and I'm looking for. Let's go back to the 5 minutes. A measured move, right? So we're looking for a measured move. So we take this high and this. Sorry, this low and this high, and just grab the fib and extend it. Okay, this is the end of your trade. That's your target. Okay, that's the end of the trade. You're done. So I wasn't in this trade, and I explained why. Well, the simple version is when I woke up, sorry, not when I woke up, when I checked my chart at 9:30, well, just before 9:30, price had already moved over 100 points from there, right? So from there to there, we were over 100 points. And my overall thinking is once price has effectively delivered for the day, there isn't any point to me getting really involved, right? I just don't see the point. And it was Friday, so that's the reason I didn't get involved. And I explained in that video how I break down the day, right? So in terms of points value, and I have another video that breaks it down further into micro sessions. So I can do the same for a micro session. If we've already maxed out the point value for the micro session, then I'll just decide, okay, I don't really want to get involved in it. But I'm still tracking price. I'm still looking at the two-step. I'm still seeing what is working and what isn't. So every 3 months or so, I can then review my trades. But that's it overall. So that gives you hopefully a high level view of the weekly, as I don't have biases or use biases. I have an observation, which is overall bearish, but like I said, I gave the reasons why I'm bearish in my weekly videos. Um, but price can go either way. It can go either way. You can also see the two-step on the Friday session as well. So thanks for watching, and I'll see you in the next video.